medico, I'd be looking at banks that accept 100% of overtime.
Yeah, I think if you run the numbers, try not to be too attached to one particular property.
Significantly impact your borrowing, you're probably going to have to close it on settlement. I'm not really a fan of borrowing for car loans. I'd much rather that money go into a leveraged asset like property that's going to go up in value rather than go down and hold you back from borrowing any further. So there's a lot of opportunity cost. And
Hello, everyone, and welcome to another episode of Passive Income Doctor. Today, I'm joined by Leon, who is a newly graduated doctor, starting internship, and also mortgage broker. And today, we're going to be talking about 6 ways to improve your borrowing power. Welcome, Leon, to the show.
thanks, Dr. Dan. Yeah, I'm excited to be here. Should be a lot of fun.
Yeah. So, borrowing power is a very commonly asked question. People ask, how were you able to, grow to a 12 property portfolio? And I'm sure people ask you as well, even as a med student, how you were able to get three, which I think is astounding. And obviously, borrowing power, isn't as easy as it once was, 2017 kind of APRA, regulations. But obviously, we have to work with what we've got in the system we've got. Um, I'll preface it by saying, when I was growing my portfolio, I remember someone teaching me one thing which I found is very true is that there's kind of two rate limiting ingredients, if you like. If you're kind of baking a portfolio, one is, you're either out of deposit or equity, or the other is lack of borrowing power. And you just have to find which one you're kind of lacking and try and work on that one. So obviously early in my journey when I was an intern, or med student, deposit was a very difficult thing, kind of didn't come from a wealthy background, had to save up every dollar myself. So that was the difficult bit. But then later, as the portfolio, slowly and steadily grew and also income grow as you go through the PGY years and get fellowship, etc. Then the next difficult step was the borrowing power, and also kind of managing how much debt you already have. So I guess there's a few ones, but let's kick off with the first one, which is to increase income. Any thoughts you want to share about that one?
Yeah, so I guess with income, from my perspective, I was trying to borrow as a student, which is really hard. None of the banks would take any application from me until I come across one bank that was a little bit more lenient, and I was able to work really hard during university on a casual income, working multiple jobs, and I was able to grind really hard for 6 months. And then the bank was able to annualize that figure to turn it into a pretty decent full-time salary. Like it was like 60 or 70K. And that was enough to get me my first loan, which was, I think, 450K back in the day. The rates were low, so it was possible. And then moving forward, I wanted more because I was seeing, Brisbane and Perth looking really good for growth, and I had no sort of borrowing capacity. I was like, how can I get into these markets that I know are going to do well without missing out? And so, yeah, eventually was able to convince my dad to jump on board as a co-borrower and structured the loan so that it was mostly me on the title, responsible for everything, but then I just used his pay slips to secure me the loan, basically. And so, yeah, any sort of income that was increased from my part didn't really make a big difference because my dad was doing the heavy lifting on that aspect. So the biggest thing that helped me in that situation was actually providing a higher deposit. So I worked multiple jobs, and I did a lot of cash jobs as well. So working for, as I was an Airbnb cleaner, sometimes I did some med school tutoring to help people get into med school. I was doing, marketing for different companies on the side. But none of that was really helping my income that the banks would consider because it's not ongoing and full
Hmm.
time and permanent. So, and I knew that. but I knew that any sort of cash would be able to contribute to my deposit, and that would still help because then I wouldn't be able to, I wouldn't have to borrow as much, or I could put it all into the offset, reducing the repayments.
Mm.
So yeah, I guess it's important to think about if you're trying to increase your non-assessable income to help with your deposit, which was my situation, or increase your assessable income, which would be, yeah, getting another job or working locum shifts and that type of thing, which is what I'll have to do next.
Yep. And just putting myself in the mind of our listeners, they might have the question, when you said annualized, like how many months did they take? Did they have to take 3 months or 6 months to annualize it?
Yeah, so these guys took 6 months of my payslip, so it was definitely a grind for half a year. But then the fact that they were able to double that and make it an annual salary allowed me to get my first one, and yeah, so it was all worth it.
Yeah. And another question, I guess, was it hard to convince your dad to come on as a co-borrower? And any
Yeah,
strategies for if we have med school listeners?
yeah, I think yes, it's hard. It's different for everyone. Everyone's got their own sort of dynamics, but given this how the lending is in this time of life, I think, asking for help is becoming more necessary and normal. So, as long as you can sort of, if it's possible for you, then definitely try. I think, I was talking to my dad all the time about different areas to buy in, and he wasn't really that interested in doing it himself. But then I demonstrated that I had the knowledge, and
Mm,
I think he was confident to sort of put his investment in me to make the right decision. So yeah, I'm very grateful that he did trust me because yeah, I definitely couldn't be here without what he allowed me to do, and it's now set me up so that now I am starting full-time work. I've got a bunch of equity that I'm sitting on and have options that I otherwise wouldn't have had.
yeah, perfect. So in terms of ways to borrowing power, improve your borrowing power, number one is improve income. And then obviously you touched on accessible and non-accessible income. Um, I guess number two will be, reduce credit card or reduce personal loans. Um, so obviously as our resident mortgage broker, Leon, how bad is credit card debt?
Yeah, so credit cards are interesting. I think it depends on, what your borrowing capacity looks like. They can be a significant burden on the amount you can borrow. A 15 grand credit card, even if it's paid off, can affect your borrowing capacity by 50 to $100,000
Wow.
because the banks don't consider if you're paying it off regularly. And a lot of people might get them to increase their credit score. But really, if you're, first time borrower, haven't got any debt, you really shouldn't have a negative credit score anyway. So you don't really need to try and make it better than it already is.
Okay.
Um, so yeah, I think that credit cards can be good for points and that kind of thing if you're not wanting to borrow, but if you're wanting to build an investment portfolio and you're opening a credit card to get points, that's going to significantly impact your borrowing. You're probably going to have to close it on settlement to get the bank approving your application. And then, I don't know, you can reopen it once you have the loan. Um, but yeah, I think the money made from leveraged assets in property is a lot more than what a credit card will give you.
Mm. And that's a good point, isn't it? It kind of, it depends. Obviously some people might be uh, at a stage of life where they're not particularly interested in investing or growing their portfolio, and having credit card points to get some airline points is fine. But I guess if you're trying to grow your asset base, set yourself up for the future, kind of weighing up the opportunity cost of having a large credit card. I mean, one thing for what I did is also kind of, reduce, the credit card limit as well.
Yeah, yeah, fair enough. I tried to get a credit card because I was going on all these holidays and thought, I may as well be getting something out of all this money I'm spending. But because I had so much debt, I actually didn't couldn't even get accepted for one.
Yeah. Um, and I guess personal loans would probably come into this category as well. Um,
Yeah, yeah. Very high interest rates. don't get a personal loan.
Yep. Yeah. All right. And a third way to try and increase your income, I guess, this is similar to the second one, is talking about car loans. I know a lot of people get, finance
Mm.
cars, a lot of time go to a car dealer, they want to sign you up for finance, low interest rate introductory offer. And then also as well, it could be maybe this might fall into it as well, novated leasing, kind of salary packaging. But my understanding is that it can impact the borrowing power quite a bit. Is that correct?
Yeah, so novated leases we can put the add backs in, but it obviously isn't as good as not having one at all, but isn't as bad as having having a car loan without
Mm,
the novated lease. So yeah, don't I'm not really a fan of borrowing for car loans. I'd much rather that money go into a leveraged asset like property that's going to go up in value rather than go down and hold you back from borrowing any further. So there's a lot of opportunity cost and unnecessary expenses you can get. I've just actually downgraded my car to a little hatchback to get around the city, and it's great on fuel. It's great on maintenance, and it was like 4 grand. So,
yeah. Wow. Yeah, I know I'm still driving the same car as when I was a med student.
oh, nice. What
Get
car
some
is it?
it's a 2007 Honda. So it's,
Nice.
it's the insured value of just watching it every year go down and down. But look, um, you know, I, I, I see the bigger picture, and to be honest, as long as it, for myself, as long as it gets from point A to point B safely, that's what I'm after. But I know, some people are very into flashy cars and that sort of thing. But then again, I think for doctors who are into cars, I'm not saying don't buy a nice car. You can kind of buy your asset, have a portfolio growing up, you know, X percent a year, say it goes up, say 5 million portfolio going up 10% a year, 500 grand a year. Then if you spend, 100, 200 grand on a car, then, make more sense then. All right. Uh, Fourth way in terms of increase your borrowing power, I guess, is finding an investment savvy mortgage broker. And obviously, some people will go to a bank directly or use like an online borrowing calculator. Do you want to touch on maybe what are some pitfalls of, going to a bank directly or using, the online borrowing calculators?
Yeah, so the benefits of brokers initially is the fact that they shop the banks for you and they've got access to like 40 different banks that they can plug in your values into and see what borrowing capacity you have. But the other thing is that they know every different bank's policies. And so if you're, a Medico, that there's certain banks that offer better benefits than others that the client might miss out on just by because they've looked up the wrong bank and they're just going to go with them without doing the research. So, for example, as a medico, I'd be looking at banks that accept 100% of overtime because that will add to your income and boost your borrowing power. I'd be going with banks that don't that offer the LMI waivers and you can get in with a 5% deposit. That way, even if you have 500 grand cash, that's better off sitting in the offset and you just giving up 5% of the deposit rather than 500 grand that's now locked up in a loan.
Mm,
That way it's more liquid. You can access it for the next one easier. Um, and yeah, just parking in the offset, it's going to make your repayments the exact same.
yeah.
Um, what else? What else can I tell you? I think third tier lenders is also a benefit of going with an investment savvy mortgage broker. Often, when you get to two or three, you get your capacity, you sort of reach your capacity with the bigger banks. And that's when, if you're wanting to keep going, you're going to have to look at third tier lenders that might have an interest rate a bit higher, 0.5% more, but they'll give you a higher borrowing capacity of, 1 or 200K.
Mm,
And that difference is going to allow you to make a lot more money from the long-term capital growth on the higher leveraged amount. Um, and I think, yeah, I mean, if you're speaking to a mortgage broker who's built a portfolio themselves, that's going to be really helpful because they have insight into how to structure it, what they've done, and they can share tips about what to buy, where to buy, how to look for things. Like I'm always helping my clients buy properties. They're sending me listings and I'm giving them feedback saying, probably wouldn't get this one because, there are power lines or there's easements out the back that I can see. The side access isn't over 3 meters, so that's going to affect your ability to subdivide in the future if you want to. All these different things that can be really helpful that otherwise the bank or the another standard broker wouldn't talk about because they're more interested in just the transaction.
Mm.
Whereas, yeah, I'm really keen to help out health professionals build a portfolio based on their long-term plan. So I would talk to them about what they want in 20 years' time, how much passive income they want, and then work backwards and take the steps required to get there.
Yeah, I would add a side note, in terms of borrowing power, you can squander it, if you you know, get slightly more borrowing power, but then you buy a dud asset, then
Mm,
sets you back, that doesn't grow, then you can't pull out equity and go again. I've had lots of doctors unfortunately reach out to me and tell their scenarios or stories where they were hamstrung for even up to 10 years, probably not
wow.
going up in value for that long.
Mm,
So I guess it's kind of having good borrowing power, but then also using it well so that you can improve your borrowing power, if that makes sense. Kind of it could even be grow your equity, redeploy, or even if it grows, has run its cycle, you could sell and then, turn one property into two or three, for example. So I think having a good mortgage broker and finance strategy is very important, as well as also a buying strategy as well. And there's
yeah.
many other episodes on that for listeners who want to check it out.
So you did that yourself, didn't you, Dan? Do you want to talk about that?
Yeah, so I have used a few buyer's agents throughout the time and also used a few different mortgage brokers as well. I think don't be afraid to get a second opinion. And also as well, I was very passionate about property. I spent a lot of spare time consuming content and then also pounding the pavement, calling real estate agents, forming relationships with selling agents, talking to property managers, talking to other investors. I think surrounding yourself with other like-minded property investors is very important. And I guess that's why we do these podcasts and also have a Facebook group exclusive for doctors, dentists, which we can drop in the show notes as well. And yeah, it can be very difficult at times, but and for me recently, it's paperwork associated with purchasing properties in trust. But,
Mhm.
you know, having a bit of short-term pain for long-term gain, I think it's worth it.
Yeah, so you recently sold two that were underperforming, is that right? And then that allowed you to get seven?
Yeah. So in the last 18 months, I've sold two, and that enabled me to purchase seven more.
Wow.
Now, the two I have looked back, I thought I timed it perfectly, but I guess this is another example. It's hard to time anything perfectly.
Yeah.
They still have gone up, but then again, you look at the big picture, if it's allowed me to move forward, then it's worth it. Although time will tell as well. Yeah.
So were you at your capacity when you had those two, and then that mobilized capacity to get seven more, or
Yeah. So obviously, this is not financial advice, everyone, but I guess, talking to your advisor, talking to your mortgage broker, you can run different scenarios. Hey, what happens if I sell this property in personal name? How much borrowing power will it free up? And, and what could I do with the property portfolio? So yeah, I think if you run the numbers, try not to be too attached to one particular property, that sort of thing.
yeah,
Yeah.
nice. So I guess you probably bought in trusts to increase that capacity. How many have you got in trusts now?
Yeah. So, yeah, I think a lot of people do say caveat. It's not so much increasing your borrowing power, but preserving your borrowing power.
Yeah.
So, so the last seven have all been in trusts. Yeah.
Oh wow. Yeah,
Yeah.
okay, nice.
Yeah.
It's a lot of
Um,
paperwork.
it is a lot of paperwork. And also, we will do another episode about what's changing this year as well.
Sure.
But all right. So let's we're up to, let's see, I lose track. So we've obviously ways to improve borrowing power is improve income, um, reduce or get rid of credit cards. Number three was get rid of the car loan, or novated leasing. Number four is having a financing strategy, having an investment savvy mortgage broker. And then number five is check the credit history. And just from my understanding or reading, sometimes you might have had a bill that you forgot to pay or something like that. And I think sometimes it can affect your borrowing power. Is that correct?
Yeah, so the broker will check your credit history before they submit your loan to the bank, and that's kind of their way of making sure that this will get approved, and they'll flag any problems with you before submitting it to the bank. So yeah, just chat to your broker about that. But yeah, if you're just new to investing and haven't had any loans or haven't been late with any bills, then your credit score will be pretty boring, and that's good.
Yeah. And finally, number six is, I guess we already touched on, is consider reducing debts or selling property strategically, right? So we talked on sometimes you could consider talking to your advisors, selling some debt, selling some property to reduce debt in personal name, and then perhaps explore going to a trust, for example. But then another one could also be consider rent vesting, right? Rather than having a high principal place of residence debt. And I know a lot of doctors, they might be in the big capital cities, such as Sydney, where, to purchase a home um, can be very high and the mortgage repayment could be very high on an owner occupier. Um, I don't know if you've got any numbers or examples about people that kind of rent vest versus having an owner occupier and the borrowing power.
Yeah, so I made a post about this recently, comparing the two on someone who has a 40K deposit, $100,000 income, and I actually compared on my Instagram what their borrowing capacity looks like moving forward and put it in all my calculators. And so basically, what it came out as is that if you were to get a PPOR to live in, owner occ, you would be getting a borrowing capacity of around 420K. Um, and that's going to cost you about 35 grand in repayments to hold because you got no rental income coming in, and that's 35 grand that's not tax deductible. Whereas if you were to get an investment loan, you're going to get a loan of about 700 grand. And the repayments, if it's interest only, which is what we suggest, if you have the capacity to do that, the repayments will be about 12 grand on interest only. And all of that 12 grand would be tax deductible. So you're maximizing your tax deductible debt that way. And because you're buying an investment, hopefully in a high growth suburb that the data looks good at, that's going to grow. It should grow more than 10% for the first year at least. So then you can release equity in a couple of years, keep borrowing. And compared to the owner occ, it's very rare to find an owner occ property that is in a high growth suburb as well. You kind of have to compromise and choose one or the other. So, you're probably not going to get 10% growth on that either. And then you're not going to be able to borrow more and release any equity. So, in 10 years' time, that can add up to be a difference of millions in your net worth because one property is holding you back and the other one's actually letting you keep buying.
Yeah. So what was that difference again in terms of it was assuming 40K deposit and was it 100K income?
Yeah, 100K income, it's about
Yep.
200K difference in
200K
borrowing
difference.
capacity.
There you go. That can be
Yeah.
uh, clickbait for this episode. 200K borrowing
The
difference with rent vesting. Yeah.
Yeah, the reason is because your investment property is getting rental income, and so you can claim 80% of that rental income and add that to your income for calculations. So that's why it's a lot higher. The interest rates are a little bit higher, but certainly not more to not do it. You know what I mean?
Yeah. All right. I think that will do for this episode. Do you have any closing thoughts about for our listeners who are looking to improve their borrowing power?
Yeah, I actually forgot to mention about hex debts. So everyone seems to be in a rush to pay off HEX debts, and it really comes down to if you've got an issue with your borrowing power or deposit, like what you were saying earlier, Dan. If you have a lot of cash and you're limited by your borrowing capacity, then you need to free up debt. So it makes sense to use all of that spare cash to pay off your HEX debt, and then that will mobilize. Paying off a 50K HEX debt might mobilize about 100 grand in borrowing capacity. So that's going to be useful. Whereas if you don't have a lot of cash, but you've got heaps of borrowing capacity, there's no reason you should be paying off your HEX debt because you've got enough borrowing capacity to withstand that debt. You may as well keep saving your cash and put in the offset. Does that make sense?
Yeah, that definitely
Yeah.
makes sense. I think also as well they've changed some ways. Is it they assess the hex debt as well, so it's not as punitive as before or something like that, or
Yeah, absolutely. Yeah, I wouldn't be in a rush to pay it off.
yeah. Awesome. Well, thanks everyone for joining another episode of Passive Income Doctor. If you found this episode helpful, maybe you have someone in your life, a colleague who's also interested in property investing and looking to improve their borrowing power, then please forward this episode onto them. Subscribe, follow our socials, which we'll put in the show notes as well. Until next time.